Welcome back. Now at the full-year mark, Absa has eked out a 1% lift in annual headline earnings per share. This has an increase in operating costs and a 13% rise in impairments weighed on the lender. Despite this, a dividend of nearly 14 Rand has been declared, reflecting an increase of 5%. Kokkie Kooyman, who's a banking analyst and portfolio manager at Denker Capital, joins us with his assessment of this performance. Kokkie, always a pleasure. Good afternoon to you.
Afternoon.
All right, let's talk about, yes, please do go ahead.
It was indeed an actual disappointing result. Flat earnings, depending on which number of shares you use, but let's call it flat. Dividend increased by 5%. But one must bear in mind when you look at these results that the environment is very tough, very low growth environment, and as a result of the large number of interest increases we've seen. So when interest rates go up, obviously that puts pressure on the consumer, their spending ability, and Absa saw that specifically in their bad debts. So they had to increase their provisions quite a bit. And I'm looking across the lines against the other banks that recently reported, Nedbank and Capitec, and you can see Absa's loan growth, even in this environment, was only 4.8%. Well, Nedbank's was only 1%. But the net interest income was still fairly good, 12% up because of higher, what we call net interest margins. So because of higher interest rates, they can charge more on the loans that they give, and deposit prices tend to lag. So the net interest margins open up. But if you look at fee income and so on, that was largely flat. So there were positives. The two positives was the commercial bank and the investment bank, very, very good, and very low bad debts. And then what they call ARO, the Absa, the African regions, also did very well, also fairly low bad debts. So, the retail side in South Africa, and specifically unsecured, needed very high provision increases for bad debts, whereas the commercial bank continued doing well and Africa did well. So everything together, it's a flat earnings and a bit disappointing compared to what the others did. The positive is Absa have been spending a lot of energy and focus and costs on improving client service, on improving their as we call it, the technology, to improve the experience. And you can see that in the strong growth in their digital client base. So more and more clients, I think it was up 17% growth in digital clients that are actually using their services. So, that will stand them in good stead going forward. But for this year, we're actually only seeing the expense and not yet really the result of that expense.
Yes, you have made the point of the issue of fee income being relatively flat to net, interest income. And of course, like you've said, a lot of the banks are seeing that being really where the green shoot is for them. But when we speak about issues of fee income, considering the macros, and then I think you've even mentioned the state of the consumer, a very, very difficult thing to kind of increase here. But then where else would growth come from, Kokkie, if anywhere else from at least a earnings perspective?
So the growth and the same is from Nedbank, which is a bit in the same position. Nedbank is more commercial and investment banking driven as a percentage of the income. But on both of them, they're seeing the income growth on what at the moment renewable energy and then infrastructure. The hope for banks in South Africa is that post-election, the drive towards improving our infrastructure continues. The cooperation between the private sector and the government, and that we'll get the private sector becoming more and more involved in funding infrastructure development, because the government has actually run out of money, and in fact the debt levels are too high, and that will be beneficial to the banks, and specifically Absa as well, and Nedbank. So I think that will be one area. And then interesting for all the banks, Africa still remains a growth driver of earnings. And that's largely because the average African country is still showing a higher growth rate than ours. When you look at the exceptions, Nigeria, Ghana, Egypt, then those are battling. But there's a lot of other countries where, especially where our banks are involved, Mozambique, Tanzania, and Kenya, where the growth rate is higher than South Africa. So for South African banks, especially for the first half of 24, the growth will come from infrastructure, renewables, and then our corporate side, and then Africa.
When we're trying to take a look at impairments, Kokkie, and look at them from a very sober, perspective, we are seeing here impairments increased 13% for Absa. I'm keen to contextualize this number, maybe looking at our competitors, but also from the perspective of Absa increasing that loan book by 4.8%.
Yeah, so it's very important, as you say, to give the context. Firstly, what we're seeing at the moment is a lot of provisioning. So the banks first have to, when the macro environment deteriorates, they have to provision, and they can also see clients migrating, and it all becomes very technical these days with the regulatory changes from what we call stage 1 to stage 2 to stage 3. Now, those stages simply mean that the worsening condition of a client or the worse, it's more difficult for the client to repay its loans. As they can see the clients deteriorating, they have to provide more for the potential bad debt. So the actual bad debts are still not too bad, but Absa is at the higher end. You can see the non-performing loans last year were 5.5% of total loans. This year it's 6.3%. So that actually is quite a growth in the actual non-performing loans that are not being able to repay or make good their commitments has increased by 20%. So against a loan book that's growing at, let's say, 5%, you can see that is actually a deterioration. Compared to the other banks, Absa's is the worst. But remember, they've also got more of a focus on that end of the market. So one would expect that. If you look at the actual bad debt, then it's still not too worrying. Most banks will always tell you internationally as well that we'll work through a cycle. And when the economy deteriorates, you expect bad debts to be higher. So Absa are at the higher end of that level. But as the economy, and if the economy does indeed improve towards the end of next year or during this year, then that bad debt charge will come down, and loan growth will pick up. I mean, interesting. I was listening to Mike Brown this morning, Nedbank, and as Mike Brown says, at the moment the South African economy grows at 0.5%. If the private sector government initiatives bear fruit during 24, 25, we could quite easily grow at 3%. Even 3% is a very low growth rate for South Africa. The difference between a 3% growth rate and a 0.5% growth rate is immense. Just for the consumer, in terms of job creation, in terms for business, in terms for the banks, in terms of even treasury in South Africa, because there's more tax. So at the moment, we most probably, hopefully, at the end of the negative cycle, and that post the election, nothing much will happen before the election, but post the election, if we have a fairly good outcome, then we should move into a better cycle.
Well, Kokkie, it's been a pleasure hearing from you. Thank you so much for unpacking these numbers for us. That was Kokkie Kooyman. He's a banking analyst and portfolio manager at Denker Capital.